The figures are black and white and in neat rows and columns. And financial reports are so professionally presented nowadays, you'd think that the numbers must also be very precise. But arriving at these numbers requires judgment. And because judgment is subjective, some say accounting is more of an art than a science. And this opens up possibilities for creative accounting practices.
Either the standard is not very clear, therefore they exploit the ambiguity, or the standard provides some options, judgment area, so therefore you can exercise your judgment in either way. So you use that to come up with the numbers that is desirable to you.
There are many instances in accounting where judgment is required.
A company could be faced with a legal lawsuit and need to make a provision to compensate, but how to estimate before the court make a decision? So therefore we use past cases, for example, as our best estimate. And that estimate obviously can be high, can be low. So if the person has certain objective in mind, might want to lower the provision, lower the estimate. So these are the judgmental area that can be exploited.
Determining the fair value of a property also involves judgment.
The valuer take into consideration the location, the condition, the size, also predict the future movement of the price of this building. So actually this bring in even more room for professional judgment to be exercised.
And as the economy evolves, there will always be lag time for accounting standards to catch up with new developments.
Just think of service providers like WeWork. In the past, you were renting the office. Now you just go for space as and when needed. And similar developments happen in the logistics space, where in the past it was pure warehouse rental. Now it's a logistics service that is being offered. And all these kind of developments need to be captured by accounting standards, but by definition, the accounting standard setters are lagging behind.
So with no clear guidelines, the accountant will have to use his best judgment to account for it.
That opens room for interpretation judgment, and it's difficult for someone to say you're wrong because standard doesn't really provide the guideline.
Some common creative accounting practices include cookie jar reserve accounting.
In the good years, when we anticipate very high reported profit, we may want to shift some of the profit into next year. By shifting the profit to future year, so if next year we are under pressure to report profit, we have a deficit, then that profit hidden in the cookie jar can be reversed.
One good example of cookie jar reserve accounting in practice: a company facing a lawsuit can overestimate the compensation it needs to pay.
Next year, when we actually pay it, it's actually not so high. So as a result, we can then reverse the excessive expenses into next year accounting. And that is actually within the limit of accounting standards.
Another creative accounting practice is expense capitalization, or what is usually called the soft asset technique.
Accounting standard allow some money that you spend to be recorded as intangible asset. So it actually didn't go into your income statement, it didn't reduce your profit, but instead it actually went to your asset in your balance sheet. For example, company that carry out research and development. So accounting standard provided some guideline. If your development have reached a certain stage, you can actually record that as asset rather than expenditure.
While these practices are not wrong, there may be intention to mislead. So how can investors spot creative accounting practices? A good starting point is to use some common sense.
It doesn't sound very scientific, but it works. If you know that the market for retail rental is softening and your investee shows increasing rent, a question should be asked. Why is it that you are able to increase, whereas the rest of the market seems to be softening? Those are questions that investors can and should ask management and see whether they have a good answer to it. And vice versa, if my company is doing much worse than the market, I also need to ask questions, what's wrong? Why are you not in line with expectations?
Investors should also know the company that they're investing in really well.
The person needs to have been monitoring this company financial statement to know what has been the norm. And therefore, this one looked a little bit unusual, we call it unusual fluctuations. So is there a business reason behind?
Very often, such analysis requires them to plow through huge amounts of data.
We have no idea when they start manipulating. So it could have started even 5 years ago. That's why it is important to have a big set of data. That's why statisticians go for big data to really plot the trend.
Technology can help to sieve through the numbers.
You can put workflows in place, you can put metrics in place, you can have your, what you call your goalkeeping in place and saying, if your thresholds hit a certain amount, I want this to give me an alarm.
One such accounting number that can raise the red flags is a company's cash flow.
If you have a huge discrepancy between cash flows and results, you need to ask questions, because that can only mean that your results that you show in your P&L are unrealized. A company gets into trouble when they run out of cash. So you always need to watch out that your company has sufficient cash to continue operating, and that works even with a loss-making company.
The financial numbers don't tell the full story.
Look at management and look at their governance structure. So do they have a strong board? There needs to be checks and balances in place for management to explain what they are doing and justifying to their board who is actually a trustee of the investors.
Still, it's never easy to spot creative accounting.
Even experts, we have auditors who are expert in financial reporting, also miss some of this red flag during the audit, and they have a lot more access than what investors have.